We will dissect the intricate dynamics shaping the global financial landscape, focusing on a phenomenon that has captured the attention of investors and policymakers alike. The world of digital assets is holding its breath, caught in a delicate state of suspense. Bitcoin, the bellwether of the cryptocurrency market, has entered a period of unnerving quiet, its price action locked within a tight, suffocating range. This paralysis is not a sign of intrinsic weakness, but rather a reflection of a broader market-wide hesitation. Traders and institutional players are casting their gaze toward the traditional financial sphere, specifically the behavior of stock index futures, searching for a directional cue. The next significant surge or plunge in Bitcoin. Its valuation is now inextricably linked to the opening moves on Wall Street and other global equity markets. This codependency underscores a maturing relationship where digital assets are no longer an isolated frontier, but an integrated component of the global macroeconomic puzzle. The silence is deceptive. Beneath the surface, a complex interplay of sentiment, liquidity, and forward-looking speculation is brewing.
Ow.
And the outcome will have profound implications for capital flows in the months to come. The prevailing atmosphere across the cryptocurrency ecosystem can only be described as one of profound apathy. Market sentiment, a critical driver of momentum, has plummeted to levels not seen in months, creating a vacuum of conviction. The speculative fervor that once propelled assets to dizzying heights has evaporated, replaced by a pervasive sense of caution and disengagement. Retail and institutional participants alike are exhibiting a distinct lack of appetite for risk, leading to diminished trading volumes and a shallowing of market depth. This subdued psychology acts as a powerful suppressant, smothering any nascent attempts at a breakout rally before they can gather steam. In an environment devoid of conviction, price movements tend to be reactive rather than proactive. With assets aimlessly drifting in response to external shocks instead of carving out a decisive trend, the current lethargy is a classic symptom of a market searching for a new narrative, a fresh catalyst to reignite participation and restore confidence. Until such a catalyst emerges, the path of least resistance remains sideways, trapping assets in a frustrating and confidence-eroding consolidation pattern. To truly grasp the market's current state of inertia, one must turn to the derivatives markets, which serve as the most sensitive barometer of speculative interest and market leverage. The dynamics within futures contracts for both Bitcoin and major equity indices, like the S&P 500, offer a stark and revealing picture of the prevailing caution. Open interest in Bitcoin futures, which represents the total value of outstanding contracts, has recently tumbled to multi-month lows. This sharp decline is a clear and unambiguous signal that leverage is being systematically purged from the system. Traders are closing out their positions and are hesitant to open new ones, indicating a cooling of speculative ambition and a retreat from risk. This unwinding of leverage reduces the fuel available for explosive price moves, making the market more susceptible to slow, grinding price action rather than sharp, volatile trends. The absence of significant liquidation events, which often serve to accelerate moves by forcing over-leveraged traders out of their positions, further confirms this low-energy state. The futures market is essentially telling us that the hot money has stepped back, leaving behind a more cautious, less directional cohort of participants who are waiting for a clearer signal before committing significant capital. Compounding this sentiment drag is the recent performance of a key institutional gateway, spot Bitcoin exchange-traded funds, ETFs, following a period of historic inflows that helped propel the market to new all-time highs. The tide has turned. Recent weeks have been characterized by a pattern of sustained outflows, or at best, tepid and uninspired inflows. This reversal is highly significant, as it reflects a cooling of engagement from the very institutional players whose entry was hailed as a watershed moment for the asset class. These ETFs are a direct channel for traditional capital to access Bitcoin. Their flow data provides a real-time gauge of institutional appetite. The current trend of net redemptions suggests that these larger, more risk-averse investors are either taking profits, reducing their exposure in the face of macroeconomic uncertainty, or simply pressing pause on new allocations. This cautious institutional posture sends a powerful negative signal to the broader market, reinforcing the bearish sentiment and validating the fears of smaller investors. The initial euphoria surrounding the ETF launches has given way to the sober reality that institutional adoption is not a one-way street but a cyclical process, influenced by the same risk calculations that govern traditional asset allocation. The constrained behavior of Bitcoin cannot be analyzed in a vacuum. It is deeply enmeshed in a web of global macroeconomic factors that are currently dictating risk appetite across all asset classes. Pervasive uncertainty on the geopolitical stage, persistent inflationary pressures in major economies, and the ambiguous trajectory of central bank monetary policy have combined to create a formidable headwind for risk assets. In such an environment, capital naturally gravitates toward traditional safe havens. We are witnessing a classic flight to safety, with significant flows being directed into assets like gold and the US dollar, which are perceived as reliable stores of value during times of turmoil. This rotation of capital out of riskier ventures and into perceived safety directly starves assets like Bitcoin of the liquidity needed for sustained upward momentum. As long as global macro risks remain elevated and investors prioritize capital preservation over high-growth speculation, Bitcoin and the broader cryptocurrency market are likely to remain range-bound, struggling to compete for a shrinking pool of available risk capital. The fate of Bitcoin in the near term is therefore less about its own internal dynamics and more about the resolution of these overarching global uncertainties. Despite the bleakness of the current market psychology, a cohort of forward-thinking analysts is already looking past the immediate turmoil, focusing on a more distant and potentially brighter horizon. A compelling long-term thesis is beginning to crystallize around the year 2026, which is being pinpointed as a potential inflection point for the digital asset space. This optimistic outlook is not based on mere speculation, but on the anticipated convergence of several powerful structural catalysts. Primary among these is the prospect of achieving comprehensive regulatory clarity in key jurisdictions, particularly the United States. A clear and well-defined legal framework would eliminate a major source of uncertainty that has long deterred mainstream institutional adoption, paving the way for a new, more substantial wave of capital to enter the market. Furthermore, the macroeconomic landscape by 2026 is projected to be far more favorable, with expectations of lower interest rates and a more stable global economy. This shift would fundamentally alter the risk-reward calculation for investors, making high-growth assets like Bitcoin significantly more attractive. While this long-term vision offers a powerful counter-narrative to the current despondency, its realization is contingent on the market first navigating the challenging near-term environment. The immediate priority remains the restoration of sentiment and the rebuilding of investor confidence, without which the foundation for a future bull run cannot be laid. A granular analysis of market structure reveals a crucial detail. The current cooling is more of a controlled burn than a catastrophic inferno. The significant reduction in leverage across the futures market, coupled with a general thinning of liquidity, creates a market environment that is inherently less prone to deep cascading crashes. When leverage is high, the system is fragile and vulnerable to liquidation cascades, where a small price drop triggers forced selling, which in turn drives prices down further in a vicious cycle. The current unwinding of heat, as some have termed it, means that this systemic risk has been substantially mitigated. Instead of panic-driven sell-offs, the market is more likely to experience smaller, more contained price movements and prolonged periods of sideways consolidation. This environment is less about surviving a crisis and more about enduring a period of attrition. The market is effectively resetting itself, purging the excessive speculation and weak hands from the system, which is a necessary, albeit painful, process for building a more stable foundation for future growth. The danger is not a sudden collapse, but a slow drain on morale that could extend the period of consolidation. In this ambiguous and directionless market, technical analysis becomes an indispensable tool for traders seeking to navigate the uncertainty. With fundamental drivers and market sentiment offering little guidance, market participants are now intensely focused on key technical levels on the price chart. These well-defined zones of support and resistance act as critical battlegrounds between buyers and sellers, and a decisive break of these levels could signal the end of the current stalemate and the beginning of a new trend. Traders are patiently watching for a clear breakout above established resistance, which would indicate a bullish shift in momentum, or a definitive breakdown below critical support, which would signal a new leg down. The confirmation of such a move, particularly when accompanied by a corresponding shift in futures positioning, and a resurgence in trading volume, will be the trigger for a new wave of strategic positioning. Until such a signal materializes, the most prudent strategy is one of patience and observation, waiting for the market to reveal its hand rather than attempting to preempt a move in a low-conviction environment. The charts hold the clues, and all eyes are on them, waiting for the silent standoff to finally break.